How to reduce capital gains tax in Australia. Thinking about selling your property or investments? Before you do, let's talk about strategies to legally reduce your capital gains tax. Stick around, this could save you thousands of dollars. What is capital gains tax, or CGT for short? CGT is the tax you pay on the profit from selling assets like properties, shares, or businesses. It's not a separate tax but part of your assessable income. Your net capital gain is added to your other income and taxed at your applicable rate. We've previously covered, for little-known facts about CGT, check out the link in the comments if you missed it. Now, let's dive into 7 practical tips to reduce CGT. Tip 1. Hold your asset for at least 12 months. If you own an asset for at least 12 months before selling, you qualify for a 50% CGT discount. This discount applies to individuals, trusts, and super funds, but not companies. Tip 2. Use the asset for business. If an asset is actively used for carrying on a business for at least half the time you own it, you may qualify for small business CGT concessions. These assets, called active assets, include shops, warehouses, and manufacturing equipment. However, rental properties and shares in large public companies typically don't qualify. Once eligible, you get an additional 50% CGT reduction, on top of the 50% discount from Tip 1. Tip 3. Sell after age 55, retirement exemption. If you're 55 or older, you can access the retirement exemption, which allows you to disregard up to $500,000 of capital gains on the sale of an active asset. If you're under 55, you can still use this exemption, but the exempt amount must go into a super fund or a retirement savings account. Tip 4. Hold active assets for 15+ years. If you've owned an active asset like an office or warehouse for 15 years or more, and you're 55 or older, retiring, or permanently incapacitated, you won't have to pay any CGT when you sell it. Tip 5. Reinvest gains into a new active asset. Instead of paying CGT immediately, reinvest your capital gain into a new active asset or improve an existing one within 2 years. For example, if you sell a shop for a $200,000 gain, you could use that $200,000 to renovate another property. This defers your CGT until you sell the new or improved active asset. Tip 6. Use the 6-year absence rule for property investors. If you convert your main residence into an investment property, you can still treat it as your main residence for CGT purposes for up to 6 years after moving out. However, during this period, you can't claim any other property as your main residence. This rule is particularly useful if you temporarily relocate for work but plan to return to your home, or sell it, within 6 years. Tip 7. Offset gains with capital losses. Got a loss on another investment? Use it to your advantage. Capital losses can offset capital gains, reducing your taxable amount. For example, if you made a $50,000 profit on a property but lost $20,000 on shares, you're only taxed on the $30,000 difference. In summary, the timing of your sale, the type of assets, and the ownership structure all play a role in minimizing your CGT obligations. The tips in this video are general in nature and may not apply to your specific circumstances. For personalized advice tailored to your financial situation, consult a tax professional. If you found this video helpful, please share it, like it, and follow us for more tax-saving tips.